Have you ever noticed that whenever Wall Street is crashing, Europe panicking, Asia tumbling, Malaysia's stock market often seems calmer? It's almost like our market has this hidden shield, a quiet resilience that makes global investors suddenly look at us and go, maybe I should park my money here. Well, this isn't luck. It's in the DNA of the Malaysian market. And once you understand that DNA, you'll see why Malaysia's stock market is often called a safe haven market. But is being a safe haven always a good thing? Perhaps it is secretly holding us back when the rest of the world is booming. We shall find out all of that in this video. First of all, what is a safe haven market? In simple terms, it just means a place where money feels safe during chaos. Think of gold. When markets crash, people buy gold. Why? Because gold holds value. But there are times when people want to continue to be exposed to the equities market in a chaotic market condition and yet want to be as stable as possible. For some global investors, Malaysia's stock market fits that definition. Whenever the global markets go wild, we will start seeing foreign funds flow quietly into Malaysia. But why Malaysia? Why not Singapore or Hong Kong or South Korea? To answer that, we need to understand what I call the market DNA. Take the US. Today, its DNA is dominated by the Magnificent Seven: Apple, Microsoft, Amazon, Google, Meta, Nvidia, and Tesla. Just 7 companies, yet they account for nearly 1/3 of the S&P 500. That means if you track only 7 companies, you already have a pretty good idea of where the US market is heading. Knowing this is so powerful because each of the 7 represents a global wave of change. Apple transformed personal electronics. Microsoft became the backbone of business computing. Amazon rewrote how the world shops. Tesla sets the pace for electric vehicle. Nvidia powers artificial intelligence. And speaking of Nvidia, that one company alone added more market value in 2023 than the entire German stock market. That's how concentrated the US DNA is. Now, let's look at China. The DNA here is totally different. In China, the heavyweight is not a group of companies, but the government itself. State-owned enterprises dominate key sectors like banking, energy, and telecoms. More importantly, policy direction from Beijing can change the entire market mood overnight. When the Chinese government pushed electric vehicles, BYD and NIO skyrocketed. But when they cracked down on tech giants like Alibaba and Tencent, hundreds of billions of dollars in value evaporated almost instantly. In 2021, Beijing's regulatory crackdown wiped out more than $1 trillion from China's tech sector. In China, knowing government policy is already half the game. And now, let's come back to Malaysia. Our DNA, again, very different. We don't have 7 global tech companies driving the index, nor do we have a single authority like Beijing deciding winners and losers. Instead, our market is built on government-linked companies, or GLCs, and institutional investors. Look at our largest companies. Maybank, Southeast Asia's biggest bank, largely held by PNB. Tenaga Nasional, our national utility company with the government as a controlling shareholder. Telecom Malaysia, majority GLC owned. Even popular consumer names aren't as open as you think. For example, 99 Speedmart has only 11.6% of its shares tradable. Nestle, only 13% free float. The rest is a lockup by parent companies. And here's the big picture. Foreigners own only about 20% of Malaysia's entire market. That means 80% is in local hands, mostly long-term investors like EPF and KWAP who don't panic sell. This DNA explains why Malaysia feels calm when global markets crash. There just aren't enough shares in play for wild swings. Remember in 2008 when the US banking system collapsed? Lehman Brothers went bankrupt. The S&P 500 dropped more than 50%, wiping out trillions of dollars. Panic spread across Europe and Asia. Malaysia wasn't spread. The KLCI fell about 40% at the time, but here's the difference. In the US, investors were selling everything. But in Malaysia, our big local institutions like EPF and PNB held firm. They couldn't just dump shares. These are pension funds with long-term mandates to protect our retirement money. So, while prices fell, the market didn't spiral into a bottomless pit. Within 2 years, Malaysia had already recovered much of its losses, while Western markets were still licking their wounds. Fast forward to 2020, the COVID-19 crash. This was the ultimate test. Borders shut, planes grounded, businesses froze, global stock market collapsed in March 2020. The S&P 500 fell more more than 30% in just weeks. Malaysia, the KLCI plunged nearly 250 points in a month. It was brutal. But here's the fascinating part. Local glove makers like Top Glove and Harta Lega suddenly became global darlings. Their share price went up as world scrambled for medical supplies. At the same time, dividend-heavy banks stabilized investor sentiment. I can continue on and on giving you more examples of how Malaysia is a resilient, safe haven market for global investors. But let me throw you a curveball. Being a safe haven sounds nice, right? But it's not always a blessing. We look great and attractive when the world is in chaos. Investors praise us for our resilience. But when the world is booming, when the Magnificent Seven are surging in the US, when India is growing like crazy, when Indonesia is attracting capital for growth, Malaysia often gets left behind. Why? Because our DNA that keeps us safe also slows us down. Since a big chunk of shareholding is locked up by government funds or family owners, there's very little room for excitement or big moves. On top of that, the makeup of our index leans heavily on banks, plantation, and utilities. These companies are stable, yes, but they're not exactly the kind of global growth stories that get international investors fired up. In the last decade, the S&P 500 nearly tripled in value thanks to tech giants powering years of growth. The KLCI, it almost moved sideways for an entire decade. That's the trade-off of being called a safe haven, steady in the storm, but often stuck in the calm. So, is being a safe haven actually good or bad? The truth is, it really depends on what you want as an investor. If your goal is stability, dividends, and less drama, then Malaysia is a great fit. Our market behaves like that steady friend who never lets you down. Not flashy, not exciting, but reliable. You won't get whiplash from sudden crashes, and you often get a nice stream of dividends from our banks, telcos, and utilities. But if you're chasing high growth, Malaysia on its own probably won't get you there. For that, you need to look elsewhere, to US tech for innovation-driven growth, to China for scale, or to India for momentum. That doesn't mean Malaysia is useless. It means you have to be clear about the role you want Malaysia to play in your portfolio. Every market has its own DNA. Some are built for speed, others for safety. Your job as an investor is not to change the DNA, but to understand it and then use it. Now, let's get practical. How do you actually trade or invest in a safe haven market like Malaysia? Well, the advantages are clear. Malaysia gives you stability, dividends, and less drama. You can buy into strong local banks, utilities, and consumer giants that tend to hold up in tough times. Many of them pay consistent dividends, which means you are not just waiting for prices to go up, you're also collecting income along the way. For conservative investor or someone who just wants peace of mind, that's a big plus. But there are also disadvantages too. Malaysia's market is small compared to global giants. Because so many shares are tightly held, it often lacks the liquidity and excitement that attract big growth investors. If you put all your money here, you are missing out on the growth stories happening elsewhere. Whether it's US tech, India's booming middle class, or China policy-driven sectors. So, how do you maneuver this? The smart approach is to treat Malaysia as the anchor of your portfolio. It gives you resilience when the world shakes. But then, you add boosters from other markets like US tech for growth or emerging markets for momentum. That way, you're not forced to choose between safety and opportunity. You can have both. Because remember, we live in a global village. Your portfolio shouldn't just reflect where you live, but where the opportunities are. Malaysia can be your shield, but to chase the upside, you need to pair it with other markets. So, let me leave you with this. When you build your portfolio, don't just ask, what should I buy? Ask instead, what role should this market play for me? If you can answer that, you're already investing smarter than most people. Leave a like button if you like this video, subscribe, and see you in the next one.